Okay, good day, everybody. Hope you had a good weekend. Uh, Today, we're going to finish off discussing the auditing process and probably start into our next discussion, which will be around some of the other services that auditors perform and services that not only auditors but professional accountants in general perform. And those are things called review engagements and compilation engagements. Many public companies, of course, by law, they are audited. And so everything we've been talking about in this course is indeed what happens for most public companies listed around the world. They have to have an annual audited financial statement. In addition to that, of course, we know that they have to issue quarterly financial statements to the stock markets where they're registered. So there is a lot of activity, not only at year end, but indeed throughout the year. However, in addition to those audited financial statements, many governments require that each corporation file financial statements and tax returns for the various tax jurisdictions where they have to report. And those financial statements usually are not audited. They're what we call unaudited financial statements. We will talk about more about that later today. But we first want to finish off talking about the audit process. So, in summary, where we've been throughout the course is essentially we started talking about the professional ethics that auditors are bound by. One of the most important being the independence rule. But we also talked about other standards that auditors have to meet with respect to maintaining quality control in their firms. And you did an assignment on that earlier in the course. And then we got into talking about the actual audit process itself in terms of the audit planning the auditors have to do. And then we got into talking after the midterm exam about the various cycles that auditors audit. Auditing in cycles is one of the most efficient ways the auditors can actually do their work, because as we've seen, for example, the revenue receivable receipt cycle, there are various account balances, but they're all part of the one cycle. And so if we audit transactions as a cycle, that's a very efficient approach. During the course of the audit, of course, part of the purpose of an audit is to detect and correct any errors, especially material errors that exist in the financial statements before they're actually issued to the users. And so during the course of the audit, auditors will summarize errors that they discover during the course of the audit. And that's really the first thing I wanted to discuss with you today was that whole process of recording of errors and how financial statements get adjusted by auditors in discussion with management. And so I've drawn up PowerPoint from chapter 16 here. We won't review them all. I'll just touch base on a few of these. But what I would encourage you to do is in the textbook, have a page at look at 712, okay, page 712. And that contains what they call a worksheet, which accumulates all of the errors discovered during the course of the audit. And if you study that worksheet enough, you'll see that it identifies where assets are overstated or understated. It identifies where liabilities are overstated or understated. And then it identifies whether income is overstated or understated as a result of these errors that are discovered with respect to assets and liabilities. And so the errors, of course, that we're talking about relate to the assertions made by management, right? So that, as an example, management asserts that inventory is recorded at the lower of cost and net realizable value. So if the auditors determine that inventory was overstated by $10,000 on their error summary, they would indicate assets overstated, $10,000, and income actually overstated as well, $10,000, right? Because assets should be written down, specifically inventory, and that would cause cost of goods sold to increase, which would actually decrease our income. Okay, and then if you look at page 712, you'll see that there are a number of errors reported on that particular sheet, and then there's some proposed journal entries to the side of the worksheet. And in essence, this is what happens at the end of the audit. Auditors have to determine by looking at that worksheet, what are they going to do about the errors on that worksheet? And so if we look at the PowerPoint here for a few minutes, we just see in the title, it says applying professional judgment to form the audit opinion and issue the audit report. Well, we already talked about actual audit reports before. So we just want to go to the PowerPoints here. Just give me a minute. I'll get to them that talk about errors, because that's really the key part we want to talk about this morning. Here we are. Overall evaluation of audit evidence and misstatement. It says the engagement partner reviews the files to make a final evaluation of the adequacy of the work. Of course, when we talk about adequacy of work, we mean, do we have sufficient audit evidence, right? And do we have the appropriate type of audit evidence, right? It goes to quantity, do we have enough? And quality, do we have the right type? Auditors provide their professional judgment, right, which we've talked about throughout the course, to evaluate, again, whether the evidence adequately addresses the risks. Right? The risks are the audit assertions, right, made by management, and to note the effect of identified and likely misstatements that could cause the financial statements not to be fairly presented in accordance with IFRS in our particular scenario. And so we're identifying, again, our assets over or understated, our liabilities over or understated, and what's the effect on income for the period. The next PowerPoint says, if at any point in the audit, the findings suggest materiality or risk assessment should be revised, auditors must determine if it is necessary to go back and perform additional procedures to respond to the revised materiality or increased risk. So at the start of the audit, we noted that in our planning exercise, one of the things the auditors do is determine materiality. But materiality in part is determined, of course, based on risk assessment, influences that. And so as we proceed during the course of the audit, if we start finding more errors than we anticipated, right, that means the accounting records may not be in as good condition as we anticipated they might. So maybe we should be lowering our materiality. By lowering materiality, it has the result of us doing more audit procedures. Okay, so we're increasing the amount of time that's spent on an audit as materiality gets smaller. And that makes sense, right? Because as materiality gets smaller, we're saying a smaller and smaller error, right, could affect the users of the financial statements. So auditors want to be even, right, have more certainty in that situation that a material error has not occurred. So the only way they can do that, of course, is by obtaining more audit evidence, which of course means more time. Okay. The next PowerPoint says the audit standards require that all identified and likely misstatements, other than those that are clearly trivial, must be accumulated in the summary of misstatements and discussed with management. So that's what's on page 712. Right? That's the error summary that would be discussed with management. So if some of you are in management roles, right, and your firms are being audited by auditors, they're going to be talking to you about the error summary and perhaps whether any adjusting journal entries need to be recorded. Now, the second bullet point says, ideally, management would correct every misstatement. Usually, in theory, that's great, but usually that doesn't happen, right? Because when management corrects errors in the financial statement, usually that has the result of income going down. And does management want to report lower income? Not generally, right? They're going to want to record higher income. And so usually it's, to some degree, there's some controversy between the auditors and management in terms of which errors are going to be adjusted. Right? So management, they won't mind making adjustments where income increases, but how about where income decreases. So there can be some level of discussion with management about which journal entries are going to be recorded to adjust for the errors. And that's why they say in the last bullet point, some misstatements will remain unadjusted, okay? And so the only ones that remain unadjusted, though, are those which are quantitatively and qualitatively immaterial. So, of course, if a number is quantitatively immaterial, it's just a small number, it's not going to make any difference to the user. However, we also have to consider the qualitative aspect of information. Right? There may be some information which is very critical to the organization. So, for example, if they have a debt covenant with the bank that says that their debt to equity ratio will not be more than 3 to 1, well, then any errors, right, that would increase that ratio, right, could be important. Even though the dollar amount might be small, if it affects that ratio qualitatively, right, the journal entry should be made. So when auditors review these errors, they not only they review them individually, okay, but they also review them in total in terms of what's the total effect going to be on the user of a total adjustment of income or assets or liabilities or current assets and current liabilities. Right? They look at this error summary in different ways to assess, again, whether there's a material error in the financial statement or not. It's just not a matter of looking at the bottom line number and saying, oh, the total errors are, $100,000 and the materiality is 125,000, so we're good to go. No. Auditors normally are going to want the errors corrected and get the errors, other than the small errors, which are clearly immaterial, they're going to want to get those errors corrected. Because if there are $100,000 of errors, the auditor would like to get that to zero, right? So have management record a reduction of profit, let's say, of $100,000. In that way, then at the end of the audit, the known errors are zero, materiality is 120,000. The auditors have more room, right, to find if there are uncorrected errors in the financial statement. Those errors can actually exist, but there's still $120,000 of room available to absorb errors. Right? If auditors release a financial statement that knowingly had $100,000 of errors, when materiality is 125,000, there's only an extra $25,000 of room, right, before there could be a material error in the financial statements. So normally auditors won't release statements on that type of a basis. Right? They want to reduce the known errors down to zero. Now, they also talk about in this PowerPoint identified errors and likely misstatements. So what they're talking about there is if you find an error, that's what's called a known error, right? So let's say you find an account receivable which is overstated by $10,000, okay? In that $10,000 amount, the total balance for that customer is $100,000, but there's a $10,000 error. So the known error is $10,000. What's the likely error? Well, then the likely error would be $10,000 divided by 100,000. That's 10%, isn't it? So our likely error out of a total receivables, let's say $1 million, would be $100,000. So the known error is 10,000. The likely error is 100,000, right? So we do a projection based on the known errors to the entire population, right? So that gives us much higher number that we have to deal with as auditors, right? In terms of potential errors. Now, a likely misstatement, let's say of $100,000, a materiality might be 125,000. In management, very often they're hesitant. They don't want to adjust for likely errors because that's just a projection, right? That's not a known number. So normally, management will adjust for identified and known errors, but they won't adjust for likely errors. So what do the auditors have to do then? Auditors will have to do more work, right, on accounts receivable, because they'll have to say, is our true error rate 10%? Okay. Again, if my receivable was one account was 100,000 and I found a $10,000 error, that means my error rate in that one account is 10%. So is my error rate in the entire population 10%? In order to disprove that, the auditors would have to do more work, right, on the rest of the receivables to see if the error rate actually is less than 10%. So of course that could increase time, right? That would have to be spent in the course of the audit in order to reduce the likely errors from $100,000 down to some other number. As we've discussed before, of course, the financial statements, including the note disclosure, are the responsibility of management. Right? So the auditors are somewhat in a tough position because they've audited a financial statement and they want to try and get management to make adjusting journal entries. But in fact, the financial statements are those of management, right? Not the auditor, right? So what we discussed many weeks ago was, what's the hammer that the auditors have, right? The hammer is their audit report. Most company managements, of course, want a clean, right, audit opinion that says the financial statements present fairly. Well, the only way they're going to get that, right, is if the auditors are comfortable with the errors that are in the financial statements, which means they have to be reduced, right, to an acceptable level. So in the PowerPoint, it says any adjustments are covered in the audit will be presented to auditee as management as proposed, so that formal entries can be made to the accounting records. Excuse me. So the auditors, of course, cannot make the journal entries to the client's accounting records. The client has to do that. Why? Because they are the client financial statements, right? So normally what happens is the auditors give a copy of the journal entries they want made to management. Management then processes those journal entries and updates their financial statements, okay? And of course, in terms of the note wording, same thing. Auditors will give what would be acceptable note wording to them. They'll give that to management, and management will either adopt it as stated, or sometimes there's more changes, right? So what we call wordsmithing, just playing with the words in order to get the proper tone, right, or direction, get the proper statement in terms of what management wants to say to the users, and then the auditors have to decide, well, is that change in wording actually acceptable to them or not? Okay. Then in terms of what we're talking about, evaluation of the materiality component in financial statements, this PowerPoint says audit tests provide a basis for deciding if unadjusted errors are material. Well, that's the whole reason, right? We do our audit tests is to detect and then subsequently correct errors that exist in the financial statements that could be material. Unadjusted errors, it says, are aggregated to see if they total to a material amount. Again, that's on page 712. We want to see how much do those errors add up to, and do they approach our materiality. If they get close to materiality, the auditors ask management to make an adjustment, right, in order to reduce the errors in theory down to zero. Okay. Now again, normally the auditors don't get there because management is hesitant to reduce profit for the year. But because management also wants a clean audit opinion, usually they will make most of the adjusting journal entries that the auditors request them to make. Okay, and this is where, of course, it becomes important that the auditors and management have some type of reasonable ability to work between them. Now, in terms of materiality, again, in looking at these statements, the next PowerPoint says, for evaluating whether the financial statements as a whole are materially misstated, uncorrected errors are put into three categories. We have the known, right, which I mentioned, $10,000 in my example. We have the likely, which was the $100,000 out of the million. And then it says possible errors. What additional error might be in existence because of the use of sampling, right? Because auditors don't look at the population 100%. So there has to be an additional component added into the error calculation that talks about possible errors, right? Because of the process of sampling itself can create errors. And so here's a little, in the next PowerPoint, it talks about error definition. So the known misstatement says is a factual misstatement identified during the audit. So again, that's my example. Accounts receivable are overstated by $10,000 out of the $100,000. Right? There's no uncertainty about that amount. We've determine specifically there's some known errors there. That's absolutely in existence. A likely misstatement says it's one that probably exists based on audit evidence examined. And so we projected my misstatement, right? 10,000 out of 100,000, that's 10%. So if the total receivables are $1 million, my likely misstatement would be $100,000. And then the last one, it says a further possible misstatement is that one could exist over and above the total of the known and the likely misstatements because of the fundamental limitations of auditing, for example, sampling risk, right? And even non-sampling risk. So sampling risk is where you take a statistical sample, and of course, because of the sampling process itself, you could make an error. Or if you don't take a statistical sample, that's called a non-sampling risk. And by not taking a statistical sample, you could also make errors, right? And so there's actually a further element in terms of potential errors. So auditors have to consider all these three different types of errors, right? So that's just to clarify that when auditors look at errors, it's just not the known errors. It's the known errors, the likely errors, and then further possible errors that might exist because of sampling and non-sampling risks in terms of how auditors do their work. Okay? But regardless of what amount those risks add up to, auditors compare those risks to materiality, and they have to get the total remaining unadjusted errors per the error summary on page 17. Sorry, 712. Okay, page 712. That error summary, they have to get it down to an amount which is less than materiality, and usually significantly less. Okay, so auditors, when they have errors, they first discuss the errors with management and the proposed journal entries. If management agrees, that's fine. The error summary is adjusted for the errors, and they'll show errors, total errors, less errors corrected, right? We'll give you the balance of any unadjusted errors in the financial statement. So when management agrees, that's fine. The problem would be, what if management disagrees? If management says, no, we don't want to record those adjusting journal entries because our income is going to be reduced too much. Well, then the auditors are going to have to probably have a discussion with the audit committee. And if the audit committee agrees with the auditors, then management is going to be approached about making those adjustments. If they still refuse, then they're going to have to go to the board of directors, right? And the directors more than likely will request management to make the adjustment recorded by the auditors, because the board of directors is going to want the clean audit opinion, right? And the board knows that unless the financial statement adjustments are recorded that the auditor wants, that the audit opinion will not be the one that the board of directors desires, right? Again, the clean or standard audit report that says the financial statements present fairly. Okay. Now, at the end of the day, if the board of directors does refuse, right, for some reason, to have material errors corrected in the financial statements, that's what's going to lead to a non-standard audit report, right, that we discussed weeks ago, in terms of there's going to have to be some type of qualified audit opinion rendered. Okay. And so worst case, right, the worst case would be if there's an adverse opinion where the auditors say financial statements do not present fairly, right? Or it could be a denial of opinion where due to a scope limitation, right, the auditors might say we're unable to render an opinion. Or there could be an audit qualification where the auditors say, except for, right, a particular problem. So for example, except for inventory, which is overstated by $10,000, the financial statements present fairly, right? So the qualified audit report where the auditors say except for, that's acceptable, right, as long as the errors are not pervasive, right, in the financial statements. So you might recall earlier on, we discussed about errors being pervasive. The idea of pervasiveness is just that an error or a number of errors will affect many accounts in the financial statements, which as a whole, right, might cause the financial statements to be misleading, in which case you could not give a qualified audit report. You would actually have to give an adverse audit opinion saying the financial statements do not present fairly, right? So essentially, the process again is the errors are identified during the course of the audit. Now, keep in mind too, the errors are normally discussed with management, right, as the audit progresses, because management doesn't want to be surprised at the end. And management normally will even ask the auditors during the audit while it's being worked on, how's the error summary coming? Because management wants to be kept apprised. Are we going to be asked to make significant adjustments to the income statement or not for the year? And so there's usually good communication, right, back and forth between the audit firm and management on the error summary, so they're not surprised. If there are errors that are discovered during the course of the audit, usually management will not agree to make adjusting journal entries until the end of the process, because they want to see all the proposed adjusting entries that the auditor might be suggesting. So they won't make them piecemeal as the audit continues. They'll wait until the end so they can see the whole picture, and then they'll decide, okay, which errors are we prepared to adjust for? And because we think some are not material, those errors may not be adjusted for. Okay? But always keep in mind, at the end of the day, the auditors have their audit opinion. And if the auditors are not satisfied, either in that the balance sheet or income statement is misleading, right? Or if the financial statement note disclosure is not acceptable, well, then in both those cases, the audit opinion will be qualified in some manner. It won't be the standard audit report, which is given. Okay, so the whole discussion with management around the error summary, very important, because it affects both potentially the audit opinion, but it also affects management's performance for the year. I mean, if income has to be reduced dramatically, it means they didn't do as good a job as maybe they thought they did, or maybe as the board thought they did. And so there may be some ramifications there as well. But again, the process is auditors accumulate the errors. They discuss the errors with management as the audit progresses. At the end, management and the auditors sit down on the error summary, discuss what the proposed journal entries are to correct the financial statements to ensure material errors do not occur. Again, materiality is judged from both a quantitative and a qualitative perspective. Okay. If the journal entries are made at that point, then the financial statement process will be fairly straightforward. Financial statements get finalized fairly quickly. But if there is disagreement, right, with management, then the issue is going to go first next to the audit committee. If there's a great disagreement there, it goes to the board of directors. If there's a disagreement after meeting with the board of directors, then that could affect the audit opinion. Right? So there's various stages at which the financial statements, in fact, could actually be corrected, okay, before a negative audit opinion would even be given. Okay, so that essentially wraps up the audit process from the auditor's perspective. Once they know the financial statements absolutely do present fairly, they can complete their file reviews and get the letter of representation that we talked about from management once the board approves the financial statements. And then the financial statements themselves can actually be issued. Okay. All right. So next, we're going to move into a discussion about review and compilation engagements. But before we do that, since that's a completely separate topic, let's just take a 5-minute break, and then we'll come back and move into the discussion of unaudited financial statements. Okay? Thank you. Linda, Okay, welcome back, everybody. We're going to continue on next with our discussion, moving into an area of substantial audit work actually done by auditors, as I mentioned a few minutes ago, with respect to what's called review work and compilation work. So both reviews and compilations are considered um, non-audit work. Okay, there's separate types of reports that are given for both of these types of engagements, and we're going to talk about how these engagements differ from audits. Okay, and we'll have a look at the actual reports that auditors issue with respect to unaudited financial statements. Just going to expand this PowerPoint a little bit, hopefully make it a little easier to read. Okay. So again, we're going to move past some of the discussion around learning objectives. So we basically have review engagements, and as it mentions in the PowerPoint, it says they took off in the 1980s. So what happened basically in the 1960s and 1970s was that the litigation environment with respect to audits started to change. The auditors were being sued more often over their work. And as a result of that, the costs of actually performing an audit started to substantially increase. Another thing that was going on at that time, especially in the 1970s, was the fact that we had a very high period of inflation. And so inflation caused auditor salaries to increase substantially, and that also increased the cost of an audit substantially. So clients were looking for additional ways where professional accountants could assist them, but where their financial statements did not always have to be audited. So we know as far as stock exchanges go, they do require public companies to still have audits of their financial statements. Again, that's basically because of the agency issue, where there's a separation of ownership from management in the case of public companies, which increases risk. And as a result, the financial statements must be audited. But in many cases, there are other reporting requirements, such as for income tax authorities, where audited financial statements are not required. In addition, owners of private companies, so family businesses in particular, but even other types of private companies that are not listed on a stock exchange, they were looking for a type of engagement that professional accountants could perform, which was not nearly as expensive. And so what happened was something called a review engagement started to come into existence and gained a lot of prominence, essentially starting in the late 1970s and early 1980s, as the PowerPoint indicates. And so review engagements, they're separate from audit engagements. They do have their own standards. We're going to look at those in the next few minutes. They are many of the standards will sound similar to the audit standards, but the main difference with respect to an audit versus a review engagement is that, for example, in a review engagement, you do not study internal control, okay? And also the type of report which is given is very different. In an audit, we call it a positive assurance report. Right? The auditors state the financial statements present fairly. In a review engagement, accountants give a report which is referred to as negative assurance. Negative assurance means that the accountants will say, nothing has come to our attention that leads us to believe the financial statements are not in accordance with IFRS, for example. So those words, nothing has come to our attention. That's negative assurance. We're not saying the financial statements are okay. We're just saying we're not aware of anything that causes us to believe they're not okay. Okay, so the type of report is vastly different. Now, an audit, as we have studied throughout the course, normally results in a assurance level of typically 95%, right? Because auditors test internal control and do other tests to ensure that a material error does not exist and that there's a 5% or less chance that a material error will occur. In a review engagement, because we're not testing internal control and we're not doing other tests of detail in a review engagement, the amount of time that goes into a review engagement is much less, but then the level of assurance is also much less. Now, the question comes up, well, how much assurance are accountants giving in a review engagement? Well, much lower than an audit, and you won't find this in a textbook anywhere, but just from general practice, it's considered that a review engagement will give approximately a 60 to 70% level of assurance, right? 60 to 70%. Well, that's a lot less than 95%, isn't it? Exactly. So the users of the financial statements take on more risk, okay, with respect to a review engagement, but it's a more cost-effective type of engagement, right? Because it costs the client a lot less money. Even less costly than that is what's referred to as a compilation, sometimes called a notice to reader engagement. And a compilation, as it states in the PowerPoint here, a compilation engagement involves preparing financial statements in good form based on information supplied by the client. The practitioner is not required to obtain any corroborating evidence and gives no assurance. Okay, so this is the difference. In an audit, you give 95% assurance. In a review engagement, again, typically considered, you're going to give 60 to 70% assurance. In a compilation, the professional standards state that the accountant gives no assurance. Now, does that mean that the user can really take no assurance? Well, probably not, because as a professional firm, you're not going to release a financial statement which you know is not correct, right? If it doesn't add up properly, for example, or if there are some glaring mistakes, right, in the financial statement. So let's say, last year's financial statement shows inventory at $100,000. This year, there's been no inventory recorded on the balance sheet. Well, that would appear to be a glaring error, right? So some obvious things, right, that the accounting firm will ask about, but they're not actually required, right, to substantiate the numbers in any way. So that's why we say there's no assurance, but professional firms, because they're concerned about their reputation, will do some low-level amount of checking on the numbers, okay? So it's not a case probably in reality where it is 0%, but let's say it's under 5%, okay? It's a very, very low level of assurance. But all the textbooks will tell you no assurance, and that's what the professional standards say as well, is that users should take no assurance from a compilation engagement. Again, we'll look at what the difference is as we go through the PowerPoints. Okay. So review services, again, this is in the context of a review engagement. It says reviewing services apply specifically to an accountant's work on unaudited financial statements. Reviews can be distinguished from audits in that the scope of a review, meaning the work done, is less than that of an audit, and the level of assurance is limited. So that's why in an audit, we said usually about 95% assurance. In a review engagement, typically, again, it's considered to be in the range of 60 to 70%. Again, you won't find that percentage in a textbook anywhere. Excuse me. So what type of work is done by the professional accountant in a review engagement? That's what this PowerPoint speaks to. It says a review, and that's a review engagement they're talking about, consists primarily of three things. Inquiry. Okay, inquiry. Inquiry is what? Asking questions, right? Asking questions of who? Of management. Analytical procedures. What's that? That's calculating ratios, right? Auditors calculate ratios, don't they? Excuse me. We talked about that earlier on. Analytical procedures is one type of substantive procedure. So in a review engagement, auditors are still doing some work, right? Analytical procedures. And then based on our inquiry of management, we have discussion with management, right? About the numbers, okay? The next point says an understanding of the entity, that's the knowledge of business, and its environment in which the business operates, the applicable financial reporting framework, IFRS, or in Canada, right, we have accounting standards for private enterprises, but every country has their own typical national accounting standards. So you have to know the framework, right, that's being applied, including identifying related party transactions or unusual transactions, the existence of, at least the existence of potential fraud, and events or conditions that may cast doubt on the entity's ability to continue as a going concern. So these are the additional items that the professional accountant will be asking management about. So you have to have a knowledge of business, right? You have to understand the business the client's in so that you can ask the appropriate questions. Of course, the same thing, you have to know the environment in which it's operating in, growing industry, shrinking industry, right? So that you can know the right types of questions to ask. You have to know the accounting framework, right? So that you know what the numbers should look like, right, under the different accounting standards. We're still going to inquire of management as to whether there were any related party transactions or not. Or based on our review of the financial statements, maybe there were some unusual transactions, right? Large gains or large losses recorded. We'd want to understand what those were about. We'll ask management whether there's been any fraud that's occurred throughout the year. We'll ask management, are they able to continue it as a going concern based on our inquiry and discussion, right? So based on inquiry, the discussion resulting from the inquiry, and our analytical procedures, again, largely ratio analysis, we're going to try and determine whether the information being reported upon, right, is plausible. Is it plausible or reasonable? Is it meaningful in the circumstances, right, in which we find our client? Now, we mentioned a few minutes ago, the standards are different for review engagements as opposed to audits. So now we're just going to walk through the types of standards that have to be met in a review engagement by accountants. Again, keep in mind, I'm using the word accountants and auditors interchangeably because review engagements are performed by auditing firms. Okay, so it's the same people physically actually doing the different type of work. It's not a different firm, it's not different people, it's the same people. So when I say an auditor does this, they'll do it in the context of a review engagement, right? Or I might say an accountant does this, distinguishing someone who's doing a review engagement from an audit of a financial statement. Okay, but in a physical context, it's all the same people that we're talking about. Okay, the general standard for a review engagement, it says the review should be performed and the review engagement prepared by a person or persons having adequate technical training. That's the same as the audit standard, right? Generally accepted audit standards, you have to have adequate technical training and proficiency in doing what? Doing a review. In the audit context, you have to have proficiency in conducting an audit with due care, right? Same as the audit standard, and with an objective state of mind. You have to be independent of your client. So you see, although the standards are different, they're extremely close, right, to the standards that we've talked about from an audit perspective. Right? You have to be independent. Why? So that other people can rely on the financial statement that you're producing. The review standards itself, moving into the actual work. The work should be adequately planned. That's what the audit does, right? It has to be adequately planned and properly executed. If assistants are employed, they should be properly supervised. Same as an audit, right? You just can't put new people out there and expect them to do the work. They have to be properly supervised. The public accountant should possess or acquire sufficient knowledge of the business carried on by the enterprise so that intelligent inquiry and assessment of information can be obtained. That's knowledge of business. Right? When you conduct an audit, you have to have a knowledge of business. Same thing here. You have to understand the business the client is in so that you can ask the right questions. And as a client gives you information, you can make an assessment. Is this information valid or not? Right? Without a knowledge of business, how do you make an assessment as to whether the information the client is giving you is correct and valid information or not? Right? It would be very difficult. So knowledge of business is actually quite important, both from an audit perspective as well as a review engagement perspective. The next standard says the public accountant should perform a review with a limited objective of assessing whether the information being reported on is meaningful. Sometimes we use the word plausible. Okay, is it believable? Okay, so is it meaningful in the circumstances within the framework of appropriate criteria? And that review consists of what? Inquiry, analytical procedures, and discussion. Right? So we have, based on our knowledge of business and the client's environment, we ask questions, that's inquiry. We discuss the answers with management, and we conduct analytical procedures to point us in the direction to ensure that the numbers are plausible, right, in the circumstances. Okay. And then B, it says we do additional or more extensive procedures when the accountant's knowledge of the business carried on by the enterprise and the results of the inquiry, analytical procedure, and discussion cause them to doubt the meaningfulness of the information. So as we do our work, right, we may get information given to us, or we discover information which causes concern. Well, when we have concerns raised, we have to investigate further, right? So that's what essentially they're saying here is, well, and you would find this in most of these engagements, you do inquiry and discussion with management, you do your analytical procedures. Most of the time, nothing comes out of that. Everything looks fine. Everything's in line with the prior year and your knowledge of the business. You issue your report. But, right, if you discover there are some issues, a fraud occurred in a certain area, right, well, then you have to investigate further, and that will take more time. If you get information that leads you to believe inventory is overstated, well, you just can't overlook that. You have to go deeper, right, and discover the extent of the inventory overstatement. Okay, so yes, additional procedures may be required even in a review engagement when you suspect the numbers are not in accordance with the accounting framework, right, that's being used. Okay, now in terms of the actual report, you'll see in the heading, it talks about reporting standards. The review engagement report should indicate the scope of the review. Well, it's going to, what the report is going to say is that it's based on inquiry, analytical procedures, and discussion, right? Exactly what we saw in the last few PowerPoints. The nature of the review should be made evident and be clearly distinguished from an audit. So in the report, we'll see it says we didn't do an audit, right? So how do you distinguish a review engagement from an audit in your report? You actually say you did not conduct an audit. The report that's issued in a review engagement says should be based on the review and state, did anything come to the public accountant's attention that causes them to believe that the information reporting on is not, in all material respects, in accordance with IFRS or in Canada, ASPE, as an example, right? The accounting standards being used. But see the wording. As we report as to whether anything has come to our attention that causes us to believe that the information reporting on is not, in all material respects, in accordance with IFRS, for example. Nothing has come to our attention. That's negative assurance. We're not saying the financial statements present fairly, right? Because in a review engagement, you're not conducting sufficient work in order to be able to say the financial statements present fairly. You're just saying, based on our limited procedures, inquiry, analytical procedures, and discussion, that nothing's come to our attention that causes us to believe the financial statements are not in accordance with IFRS or whatever the other accounting framework is that you're using. And we're going to state that no assurance can be provided, okay, in the engagement. The report, it says, should explain the nature of any reservations contained therein and if readily determinable their effect. So again, if we had inventory that was overstated, we just can't accept that, right? Because we have evidence then that has come to our opinion, right? It has come into our mind that, oh, inventory is overstated X dollars, well, we have to report that, right? So it is possible in a review engagement that you have to say that the financial statements are in accordance with IFRS, except that inventory is overstated $10,000, right? So you can have the same modifications of a review engagement report that you might have in an audit report. Okay. So in this idea of conducting inquiry, analytical procedures, and discussion. What is it that we're going to do? This PowerPoint talks to that. It says review work primarily consists of inquiry and analytical procedures. You have to obtain a knowledge of the client's business. We already said that, in order that you know the right questions to ask and can assess the information that's given to you. Make inquiries about control systems, right? For example, have there been any frauds, right? Has internal control broken down? Do you reconcile your bank account monthly, right? That's an indication that control exists in the business. And then perform analytical procedures, it says, which could include, so notice it doesn't say which must include, it could include what? Inquiring concerning matters discussed at meetings. So what's been discussed at the board of directors meetings, for example, what's been discussed at the shareholder meetings, if any, and how could those items affect the financial statements? You can ask management, are there any lawsuits, right, against the company that have been launched? And if so, again, you might even want to go to the extent of sending out a letter to the legal counsel, right, for the company, much in the same way that you would do in an audit. So a review engagement, right, is actually quite flexible in terms of how far you can take the procedures. Most of the time, it's just inquiry, analytical procedures, and discussion, because everything appears plausible, right? But there can be circumstances where things are not plausible or there are problems, and then you have to extend your work, right, even in a review engagement. Because in the report, keep in mind, you're saying nothing's come to our attention that leads us to believe the financial statements are not in accordance with IFRS. Well, if something does come to your attention, you have to report that if it's unresolved. Okay. We've already talked about the items on PowerPoint 13, so we go forward. We do get a management representation letter, okay, at the end of the engagement, just like you do in an audit, okay? And so you can see just in the PowerPoints we've gone through here on review engagements, there's a lot of similarities, aren't there, between review engagements and audits. It's just that the depth of the work that you're doing in a review engagement is much, much less compared to an audit. And of course, because you're doing less work, that keeps the cost lower. Excuse me. As is noted here in PowerPoint 14, says firms may do additional procedures, although there's no formal requirements to do so. Again, you may do additional procedures based on information you discover during your review engagement. There's no professional standard that says you must review the client's bank reconciliation or you must send a letter to the legal counsel for the company. Right? There are no such standards. But when you come back to the report, again, you have to, when you're stating nothing's come to our attention, but if something has come to your attention, you can't say that, right? You have to actually do more work to satisfy yourself that a problem does not exist. Okay, the actual report itself in this PowerPoint says the review report, they're talking about the actual report issued by the professional accountant, includes the following statements. The scope of the review says it consists primarily of inquiries, analytical procedures relating to the data, and that it does not conduct an audit. We saw that before. The accountant is not aware of any material modifications that should be made or disclosure of departures from GAAP. Okay, so we say nothing's come to our attention that leads us to believe these financial statements are not in accordance with IFRS. When you say that, what you mean is that there are no material modifications to be made to the numbers or the disclosures, okay? The financial statement disclosures in the notes. So in a review engagement, you still do the same financial statement notes that you do in an audit engagement. Okay, so the notes will look very, very similar to those of an audit engagement. It's just the extent of the work that you do in the numbers is much less. But the disclosure requirements are the same. Okay, so you can still do a lot of work in terms of putting the financial statement notes together in a review engagement compared to an audit. Okay. So let's, this particular PowerPoint says see Exhibit 17-1 for a sample report. So I'm just going to pull my textbook open here for a minute. I didn't get that page number for you. But let me give you a reference so you can actually look at what a review engagement report looks like. So it's on page 745 in the text, okay? It says Independent Practitioners Review Engagement Report. And I'll just read right at the bottom of the report. It says, based on my review, nothing has come to my attention that causes me to believe that the financial statements do not present fairly in all material respects the financial position of the company at December 31, 2000, whatever, and the results of its operations and cash flows for the year that ended in accordance with IFRS, for example. Okay? So the type of report, you can look at it there, and you'll see the format looks very similar to that of an audit engagement report. Okay, but of course it's much shorter, right? Because we don't have things like other matters, we don't have things like key audit matters, some of the other types of paragraphs that we talked with respect to an audit report. You don't even have those in a review engagement. Okay, so that's a type of report you can see there. So the next thing we want to have a look at is the other type of work that auditors or professional accountants do, compilation services. So again, compilation is also something known as a notice to reader report. So in this case, a compilation just consists of the actual financial statements themselves, the balance sheet, the income statement, statement of changes in shareholder equity, statement of cash flow. Often is not even added in, okay, because of the use being made of these financial statements. Very often it's just an income statement and a balance sheet, and if required, a statement of changes in shareholder equity. You can obviously attach a statement of cash flow, but these types of engagements typically are just for income tax purposes. The financial statements aren't going anywhere otherwise, so very restricted use, and that's why most of the time the financial statements are actually created on this basis of what we call a compilation. So again, the compilation in the textbook and professional standards say that the public accountant gives no assurance, right? So 0% assurance, okay? But in the real world, they'll say, you know, a small level of assurance because auditors cannot be associated, right, with anything that they believe would be false or misleading. So it's that association aspect from a legal context that if you issue a financial statement, which you know, right, is false and misleading, you can't do that because you could have a liability created by that. So that applies even to compilations, right? You can't release information which you suspect or know may be false and misleading. You have to do sufficient work to ensure that's not the case. But a very low level of assurance, under 5%. So in the compilation, in this PowerPoint, it says a compilation engagement is one in which a public accountant receives information from a client, so a trial balance, for example, and you arrange it into a full financial statement, the balance sheet, the income statement, etc. The public accountant is concerned that the assembly of the information is arithmetically correct. So we just do the proper adds, right, to ensure that the balance sheet balances, the income statement ties into, right, the balance sheet in terms of the change in the retained earnings. But in this type of engagement, the public accountant does not attempt to verify the accuracy or completeness of the information. In a compilation engagement, there are no financial statement notes attached to the actual financial statements. Okay, it's just the financial statements themselves. So in a audit engagement, of course, we do a lot of work, as we discussed in the course, verifying the numbers and the notes. In a review engagement, we're just going to do inquiry, analytical procedures, and discussion, but with the same financial statement notes as in an audit. And then in a compilation, you see we're even doing less work, right? Absolutely no notes to the financial statements, just the actual main four financial statements themselves. And as I mentioned, very often you don't even do a statement of cash flow. Very often you just do the balance sheet, a statement of financial position, and the income statement. Because typically these statements are just for tax purposes, right? They're going to the taxation authority in the country. They're not going anywhere else. Okay? The next PowerPoint says, unlike an audit or a review, no expression of assurance is contemplated in a compilation engagement. Why do we give no level of assurance? Because we do no work, basically, right? Other than ensuring that the numbers add up properly in the balance sheet and the income statement. Okay. So no assurance is given. It says this limits the public accountant's action to be taken. Because we're giving no assurance, we don't have to do any work. Now, if we suspect the numbers are incorrect, of course, we cannot be associated with anything which we know may be misleading, right? So normally, if we find the numbers are incorrect, we'll ask management to make adjusting journal entries to correct the financial statements. Most of the time, of course, management will do that. However, if they refuse to do it, then of course he's still in the same situation. You may have to actually withdraw from the engagement. Okay, so that may be a type of situation you're faced with that would be similar to an audit. In this engagement, each page is marked as unaudited. See notice to reader. Okay, so the actual report typically is called a notice to reader report. It wasn't in the review engagement slides, but also in the review engagements slides, each page will also be marked unaudited. Okay, so the actual balance sheet, income statement, any other statements included are marked as unaudited. Again, we want to distinguish an audit from a review engagement and from a notice to reader. So in this one, because we're doing absolutely no work on every page, it's going to say unaudited, see notice to reader, because we want to be very careful that the reader realizes they should be taking absolutely no assurance, right, from this particular engagement that we've been involved with, because again, we've done absolutely no work on the numbers. Now, the actual type of report that's given, again, this is on page 746, okay, at the bottom of the page. I'll just read it so you have an idea, but you can look at it yourself, please. Bottom of page 746. It says, I have compiled the balance sheet of, you insert the name of the client, Client Limited, as at December 31, 2000, whatever, and the statements of income, retained earnings, and cash flows for the, for example, year that ended, from information provided by management. I have not audited, reviewed, or otherwise attempted to verify the accuracy or completeness of such information. You see what's happening there? We didn't do an audit, so we say so. We didn't do a review, so we say so. So I haven't audited, I haven't reviewed, and by the way, I've done nothing to verify the accuracy or the completeness of the information given. Readers are cautioned that these statements may not be appropriate for their purposes, because the idea is most of the time these financial statements are just put together for the tax authorities. So if someone takes this financial statement and goes to the bank with it, right, to arrange financing, we're telling the reader, being the bank, this might not be appropriate. You might need a higher level of assurance review engagement. Now, in fact, what's happening in the real business world is because of cost, right? Most banks today, even though I'll suggest they probably shouldn't be, they are accepting notice to reader financial statements from clients and doing lending based on notice to reader financial statements. Okay, so it's the idea that they don't want to force the client to incur higher professional fees. So banks have made a decision, even though they perhaps should not be, they are lending based on notice to reader financial statements. Right? They really should be getting a review engagement report to ensure that the accountant spent enough time with the numbers. Excuse me. Spend enough time with the numbers to ensure that they're accurate. Right? And of course, that you have some notes of the financial statements to read as well in terms of what's been going on during the year. But in a compilation report, there's no notes, right, that go with the financial statements, just numbers. So you can see the context in which you're reviewing that financial information in a compilation engagement is much different right, than in a review or an audit. And then right at the bottom of this notice to reader we're looking at on page 746, says, I am not independent with respect to client limited. So this has been another topic of discussion in compilation reports. There are many accountants that do work for clients, and they are not independent of their clients. So until recently, that information did not have to be disclosed in the notes to or in the actual report itself. So, for example, I prepare financial statements for one of my brothers, right, who's a doctor, and up until recently, when I prepared that financial statement, I did a notice to reader, and I did not have to disclose the fact that the doctor is my brother. But now, right, I have to actually put into the notice to reader report that I'm not independent, right? And you have to note the reason why you're not independent due to family relationship, right? Or give an indication to the reader as to how you're related to the actual practitioner, right? In my case, so that the reader's aware of that, right? And so we don't want the user to be in a position where they're relying on a financial statement that they shouldn't be, right? So we have to give them some degree of information where we're not independent, because the other situation is in an audit, you're required to be independent. In a review engagement, you're required to be independent. So you can see that users might just assume, right, in a notice to reader or compilation engagement that you'd also be independent. But if we're not, we need to really tell the user about that. Right? And so the professional standards about a year ago were changed such that even in a notice to reader engagement now, if you're not independent, you need to advise the reader that you're not. Now, at the top of page 747, there's actually a comparison, okay, of compilation engagements to review engagements and to audit engagements. And it talks about the differences between the three. So you might want to have a look at that just from your own perspective, okay, with respect to how these three engagements differ from each other. And of course, they differ, as an example, the last point they mentioned, the type of report. So in an audit scenario, we have something called the auditor's report. In a review engagement, we have something called the review engagement report. In a compilation engagement, our report's called a notice to reader report, right? If we looked at the three types of engagements and we compare them based on the amount of evidence required, right? So in an audit engagement, of course, we have to evaluate internal control. In a review engagement, we do not evaluate internal control. In a compilation engagement, we do not evaluate internal control, right? That's the same as a review engagement. With respect to independence, in an audit, you must be independent. In a review, you must be independent. In a notice to reader, you don't have to be independent, okay? So again, that would be a difference there. In terms of the amount of evidence that you need to do your report, of course, in a audit engagement, you need a substantial amount of evidence, right, in order to justify your audit report. So in the summary, it says you need independent corroborating evidence. That's why we do confirmations, right? That's why we look at do tests of detail, looking at invoices to support payments made and things like this. Review engagements, we have to obtain some level of some level of evidence. How much? We'd have to do analytical procedures, right? So we have to do ratio calculation, for example, right? So we compare the numbers this year to last year. So there is some substantive work, right? Because we're doing analytical procedures, but it's not a full-blown audit where you're also doing tests of detail and where you're doing a study and evaluation of internal control. And then with respect to a compilation, of course, you're not obtaining any, right, evidence of any type because you're not required to. Right? All you're doing basically is putting the financial statements together. Again, because you're associated with the financial statement, you have to make sure it's not false and misleading, but that's just based on a cursory review of the balance sheet itself and based on your knowledge of the client. excuse me, you can come to that conclusion. Okay, so again, have a look at the top of page 747. There's a nice little summary there of the comparison of the three types of engagements. Okay, so we'll just go a little further into some of the other PowerPoints here. I'll make some other comments before we close off for today. One of the areas in which many professional accountants have gotten involved with, because of the level of wealth for a lot of people in society today, is actually doing personal financial planning. Okay, so you're looking at people's financial planning, just not in terms of the business that they're operating, but their business may be just a small part, right, of their total personal wealth. So you help them manage their total planning scenario, right? So you may have a client that operates a business. Well, because they operate that business, they may have some insurance requirements, right, for life insurance, and they may have some tax that they ultimately have to pay, right, on their demise. And how's that going to be paid, right? Where's the money going to come from that? And so you may actually put together what's called a personal balance sheet, right, for an individual. And when you put a personal balance sheet together, you would normally attach a compilation report, right, the notice to reader, because you haven't obtained any evidence, right, to satisfy yourself that the numbers are all correct. But it's essentially a guide, right, for the person in terms of looking at their total wealth. And this whole idea, this is really something that every person, right, regardless of wealth, should do, your own personal financial planning. And sort of when you're starting your career, you're starting at a certain point, and where do you want to end up, right, at the end of your career? And how are you going to get there? That's a personal financial plan. So that'll integrate with your career plan, right, with your family plans, and all those things all come together because they all have to be considered in terms of achieving your overall financial plan. So this is a much broader, right, type of engagement. Of course, it's a way to generate additional fees, and that's why a lot of professional accountants have gotten into this area. As you move into that area, of course, it also allows you to network with lawyers, real estate agents, insurance agents who may refer work to you. So it's in a way to expand your professional network as well. We've talked about the fact that public companies, of course, have to issue quarterly financial statements, but many private companies will also generate an interim financial statement. So a company that's relatively large, the bank maybe halfway through the year wants to see how the client is doing. So they may ask for a notice to reader or a review engagement to be performed maybe 6 months into the year. So that would be an interim financial statement, right, for a company, private company, and that's quite common as well. Or if a company is growing quickly and wants to approach the bank for a higher line of credit, that's typically what they'll do as well. Say we want to get a higher line of credit, the bank will say, well, we need current financial information. Can you produce a financial statement? So yes, we do a 6-month financial statement as a result to support a higher line of credit for the client. Again, normally that would be either a review engagement, or if acceptable to the bank, it might even be a compilation or notice to reader engagement. Okay, and that's pretty well internal control. You know, we've already talked about internal control in the context of an audit. Auditors audit clients' internal control systems. Management has to give a separate report today that the internal control system, right, is adequately in place to prevent, detect, and correct material errors should they occur in the financial statements. So we've already covered that as part of the audit process. Okay, so what we want to do today, we've finished talking about review and compilation engagements. Again, that was just to give you an idea about the fact that professional accountants do a lot of work outside of the audit area themselves. They do a lot of tax consulting as well, of course, general management consulting in terms of helping businesses to with marketing plans, for example, human resource plans, okay, helping management determine salary levels for key executives and things such as that. So there's a lot of different areas where, because of your knowledge of business and your knowledge of people, right, at the client organization, you can actually help your clients in many different ways. Okay, so that finishes off where we want to go there on the technical discussion of the audits and reviews and compilation. So what I'm going to do next day is I'm going to do a course review. Okay, so this will be in conjunction with helping you to prepare for the final exam. So we'll do a walkthrough and I'll be discussing with you the major topics that we've touched on throughout the course. Again, keep in mind the final exam is going to be largely geared towards things discussed after the midterm. Okay, so there will not be any specific questions relating to anything dealt with prior to the midterm exam. But we'll go over some of the topical areas, and that will help refresh your knowledge maybe in a number of areas that we've touched on. I'll suggest you do make some notes, okay, in terms of what I'll be discussing next day. And you can use that as guidance as well in terms of preparing for the actual final exam in the course. And I will be discussing next day exam because I've largely put that together now, so I know what the exam format is going to look like. Okay, so we'll share that next day. So you can start studying and getting ready for that. Good news is it's actually towards the end of April. I think it's April 22nd. I'll confirm the exact date in our next class, but it's towards the end of April, so you have lots of time to prepare for it. And then after review class next day, you should be set. If you have other questions, of course, while you're preparing, you can certainly send me an email, and I'll be glad to get back to you. I've had a few people have over the last couple of weeks or so requested Teams meetings. So if you'd like to do that as well, we can also do that. Okay. So for today, I'll sign off. Have a good day, everybody. And I'll see you on Wednesday. And that'll be our final class for the course. Okay. Thanks, everybody. Have a good day.